to bringing César Calderón into this conversation. César is joining us virtually. César, just building on the point that Jane has just made about debt sustainability and how then generally to outsiders there is this paradoxical idea that the World Bank as a lender is anxious about the debt crisis looming in Africa. Could you explain to us what is concerning for the bank about the current debt situation? And how does the bank support that it provides differ from that of other creditors, especially also in view of the idea from across the road that there is no debt crisis in that sense, and that we have not reached pre-HIPC levels for us to be worried about. César, over to you.
Well, thank you. Thank you very much for the invitation to participate in this very important roundtable. To talk a little bit about your 2 or 3 questions that you have for this round. It shouldn't be paradoxical that the World Bank as a lender is anxious about the debt crisis looming in Africa for several reasons. The bank not only has a lending capacity, but in that lending capacity, the bank is not a commercial bank. The bank is a development bank. And as a development bank, the institution is designed to provide medium to long-term capital for productive investments. I mean, it could be health, could be education, could be infrastructure projects. And that lending tends to come at concessional rates and at longer maturities than the lending that comes from other sources. In addition to that, the lending that the bank provides is also accompanied by technical assistance and policy advice. The second part of your question is about the current debt situation in the region and why are we concerned about that? I mean, I had some slides, a very small set of slides that I was going to present, but I'm going to skip that given the exhaustion on slides. But the question is, how did we get here, right? How did African countries get here? And if you look at the evolution of public debt over the last 10, 12 years, there has been a surge, a gradual surge. If you put yourself in 2010, the public debt of sub-Saharan Africa was around $354 billion. Now, 12 years after that, in 2022, that debt is about $1.14 trillion. If I have to put this in terms of GDP, we have that the debt of the region has increased from 32% in 2010 to about 57% of 2020 in 2022. Again, these are averages. So you can imagine there are countries in the region that have even higher levels of debt than 57 or 60% last year. Now, there are some of the features that the previous presenters have mentioned that also are very valid within the Africa context, within the regional context. That there has been an interesting switch in the composition of debt. I mean, the Ghanaian representative said that there was an increase in domestic debt, and that's true. Gradually, there has been an increase in domestic debt and domestic public debt. No? At the end of 2021, the domestic debt in the region accounted for about 51%, almost half of the public debt of the region as a whole. So again, we're talking about half of the debt being domestic debt. But at the same time, when we talk about external debt, if we compare to what happened prior to HIPC, where the debt was mostly to multilateral development banks and also Paris Club governments, now we have that there's a lot of market-based debt. And the participation of governments that are non-Paris Club governments, or what sometimes we call they're called non-traditional creditors, right? the other thing that I wanted to mention here is that debt in itself is not bad. I think there are several problems. Why debt can be problematic? One, if the country contracts this debt under terms and conditions that are not favorable to them. And the second part that is important is in the way that they use this debt. Whether they have a good pipeline of high quality projects, whether there is no leakages of these funds to other activities. But if we start thinking about the way that the debt in Sub-Saharan Africa has increased so sharply over the last 10, 12 years, even prior to the pandemic, we have to think about what are the factors driving. So one is an external factor that wasn't mentioned by the previous speakers, which is the accommodative monetary policies of advanced countries. We have to think about all the period after the global financial crisis and prior to the pandemic crisis, where central banks of advanced countries had nearly zero interest rates, and they have massive quantitative easing in order to support the aggregate demand of their economies. That led to an excess global liquidity and global investors that were searching for yields. And they started offering loans at very cheap rates. But this problem is very similar to when, for example, as a personal creditor, I go to a bank and they give me a low interest rate loan, but at an adjustable rate, right? So when interest rates are low, my debt service is not as big. But when interest rates start coming up, and if I have adjustable rates, then my debt service increases, right? So the problem of having market-based lending is that you can have small flows of debt services when interest rates are low, but when interest rates come up, like in the current situation that we are, then it becomes more onerous for the government. So what we had brewing over the past 10 years was African countries that were resorting less and less to concessional lending. They were going more for market-based lending. And of course, that has increased dramatically the cost of debt service. If we think about how much does it go in terms of debt service in African countries, in 2021, African countries were devoting more than 40% of their revenues to pay to service the debt, which is a ratio that is very high. At the same time, we have, and this is something that many of the speakers in the audience have said, there is high risk of debt distress in several countries in the region. Approximately 22 out of 38 countries in the region that are IDA eligible are either in high risk of debt distress or already in debt distress. And there's none of these countries has a low risk of debt distress. So the situation is problematic. Now, how can the bank help or support these countries? And I think the bank helps by providing low interest rate loans.
César, sorry to interrupt you. Maybe if we can pause on that on the bank support aspect. We'll come back in the second segment if you don't mind. Thank you very much. Because I think the speakers have done a fantastic job in situating the challenges of why the continent, broadly speaking, and then specific countries find themselves in this predicament. I think one common thread two common things that have come out for me from all four speakers is that there is an issue of transparency and accountability when we talk about fiscal management or mismanagement. And I think that is something that, as much as civil society organizations that work on global economic governance would want to wish away. It's something we can't run away from at the national level. I think this is something that is quite fundamental. But I think more importantly, what I picked up from the four speakers was that this market-based approach to development finance. I think, Grieves, Ed, Jane, and César, you've all mentioned this idea that, all of a sudden, sort of just post-HIPC, there was a period where market-based development finance and lending became a very attractive form of development finance. And to some extent, given the way these market-based instruments are designed, we are or have been a contributor to the challenges that we're facing today. And so I'd like to, with that sort of two framing common thread across the four speakers, move on to the idea of in terms of the interventions. I know, César, you started talking about what the bank has been doing, and I know the bank has been very vocal on the issue of also transparency, good transparency, accountability in terms of borrower side of things. I mean, in addition to the support that the bank is providing and its differentiated approach from other creditors, is there more that can also be done to encouraging transparency and accountability amongst lenders? And is this something that the bank might be able to support through its technical assistance and financial assistance to borrowing countries? So I'll start with you, César, and then I'll come back to the room.
Okay. No, I mean, as I was saying before, I mean, the bank provides low interest loans, zero to low interest credits, and grants to developing countries at concessional rates, at low interest rate, and for maturities of 30 to 40 years, which are a better maturity if you want to, for loans, if you want to, for instance, invest in riskier projects like infrastructure, right? Or riskier in the sense that they're riskier for commercial, right? So this is one way that we're helping. The second thing that we're trying to do is try to foster transparency in terms of debt, transparency in terms of compiling the debt, reporting the debt, and the ability to monitor the debt. But again, as we know very well, the debt is a contract, and it's a contract that is signed by at least two parts. So that requires transparency not only from the debtor side, but also from the creditor side. So one of the things that were being discussed, and I don't want to get too ahead of myself, but one of the things that is being discussed currently, and that was already proposed by the bank and the fund, is the possibility of sharing the debt sustainability analysis to all the creditors participating in the negotiation, right? At least the debt sustainability analysis would allow us to see how far off the country is from, how far off, or the ability or inability of countries to repay their debt, whether countries have a liquidity problem in the short term, or whether countries have more than a liquidity problem and they have a solvency problem, a structural problem that needs to be solved. And that's very important, because having the debt sustainability analysis as a benchmark will allow not only the multilaterals, but also policymakers on the creditor side to try to assess what should be the extent of debt restructuring that countries may need. Okay, I mean, again, this is supposed to happen in the realm of the common framework. And again, I mean, the common framework is not a perfect, it's one of the few methods to have debt resolution in the current context. It's not perfect, it's far from perfect. And I think the bank and the fund has outlined some of the challenges that this common framework has, from the fact that the process has been slow. I mean, think about Zambia, that declared default back in the last quarter of 2020, and we still have no financial assurances. And also the discussion has been slow. There are many parts of the process of restructuring that should have been discussed beforehand. And unfortunately, they're being discussed still, like the steps of the restructuring process, the timeline of this to reconcile debt, and also the issue of the debt burden share. I mean, these parts are essential in a restructuring process and need to be discussed. I mean, I'm going to try to wrap up a little bit my discussion here by mentioning the types of proposals that the bank and the fund are elaborating to address some of the roadblocks to debt restructuring within this framework. One is a debt standstill. It's like a formal debt service suspension at the request of the debtor country during the process of negotiation, right? During the process of negotiation of the restructuring. That would incentive both creditors and debtors to reach a deal and to some extent protect the repayment ability of the debtor. The second one is, as I said, share the debt sustainability analysis with all the creditors. I mean, we're talking here official creditors and private creditors. The restructuring process also needs to be accelerated. I mean, that's where we need to establish clear deadlines in the different stages of the negotiation. And the other thing that might be important in this case is try to design mechanisms to encourage private sector participation. It wouldn't be a bad idea to have the private sector from the very beginning in the negotiations. And I hope I have answered all your questions, but I think I will stop here.